right, good afternoon. Good morning to some, but good afternoon here anyway to the group. Today we are hosting our second ever scouting report. And the intent of our scouting reports at Left Field is just to introduce more operators to the community. So we've got two different operators participating today, and we really appreciate them coming on to share their information and be introduced to the company or the group. We will turn it over first off to the Riverbridge Investment Group, and Na and Rhonda, I'll let you guys take it away.
Hi. Thank you. It's my pleasure to be here. Love to share a little bit about what my company is all about. So my company is Riverbridge Investments LLC. We're a sole land development company inside in the greater Houston area. So we have been working on subdivision lots development, townhome development. We also do land banking. Right now, we're more focused on RV resorts and mobile home park project this year. And our typical deal size is, well, since we focus only on RV resort and mobile home parks, so our deal usually about 10 to 20 acres raw land, and we develop those from ground up. And a typical deal check size is 3 to 10 million. And we also do like subdivision lots, but those kind of deals we're do up to 100 acres. So that would up to like 3 to 15 million. And we usually sell those finished lots. We contract with a big home builder like Lennar, KB Homes. So we do those finished lots for them. So in Texas, there's no license required. We have in-house construction, so there's no license required for it to be a GC in Texas. We're members in a lot of associations like Houston Area Private Lender Association, and then most important is Greater Houston Building Association. Here's our kind of experience. So we have done 12 townhomes on Omega, which is inside Houston area inside the loop, very close to downtown. We're currently developing 15 acres in Fugua. We contract with the First American Homes and Cashmere Homes. This is our RV resorts that we're breaking ground right now. This is in 290 and Waller, which is a great area. We're developing 99 pads right here. They're all concrete pads. And we have a 5,000 square feet clubhouse, which it has all the amenities inside, like laundry room, shower room, gym, indoor gaming room, conference room. We have a C-store right next to leasing office. And outside right here is a sand beach. So we actually import a lot of sand and make campers feel like they're on the beach. So we have volleyball court, we have a pavilion, a rest area here, and we have a designated swimming pool right here. We have a pub golf and some outdoor gaming. On this, actually, we have a kayak and boat for rentals. We made artificial pond. So this is a fishing pier. So it brings more families activity together. And we have 2 water wheel right here. And this is a septic tank under the ground. And this is the field area. We have dump station just for the convenience for the campers to dump their solar. This is a really great, amazing project. We're so proud of. We're breaking ground on this one. So, this is a Conroe apartment, 57 units we built last, and for actually Chinese owner. So he's like almost 90% full by now. We also had renovated about 15 single family houses from 2021 to 2022. Our LP structures, of course, is GP and LP, and we had some of the deals we have straight split profit sharing kind of structure, and we have waterfall structure. So It depends on the deal. It's different. So those are the, like I mentioned, we are only doing RV resort mobile home parks. We're actively requiring a lot of land throughout Greater Houston area. There's tons of opportunity. That's what we're building right now. We're having a New Guinea RV resort. We're currently raising money for this deal. We're duplicate the same concept in New Guinea, which is another greater area in Greater Houston area, not in the Houston, because they don't allow any of those development anymore. Here's a 3D rendering for our New Guinea RV resort. So you can see that's a pond, a nice pier, and we have clubhouse right there. Here's the big outdoor kitchen. We're actually gonna put a barbecue there, so it will turn outdoor patio to outdoor kitchen. And we're gonna put 10 to 12 EV charging station. We're the first one who put in a real EV charging station on our RV campground. So we're gonna put about 4 here. We're gonna put the rest around the pond, premium pass. So we charge about $50 each pack more for that. And here's the swimming pool, and we're gonna make outdoor gaming here, like a pupple golf or some other activities. So our typical return on those kind of deals are 15 to 24%. That's from year 1 to cash on cash return. That's from year 1 to year 5, not included disposition. So for RV resort, sales cap rate is about 6% right now, and on mobile home parks, and right now it's about 5% cap to sell the property. Okay. Here's also 38 townhome we're building for a client of mine. So this is inside Houston, actually very close to the medical center. As you know, Houston has the largest medical center in the United States. Great location. We're building 38 townhomes for them. So geographically markets, like we love to build those parks around blue collar workers or refinery area, industrial, areas. Also tourist attractions. The New Guinea one, we have a lot of tourists because it's close to Lake Houston. It's close to a lot of museums, and Houston has all different kind of shows all year round. And so we love those kind of catering, those areas too, catering daily, weekly rates, basically. So we cater more to our tourists. We're also looking at, when we choose a location, we're looking at population growth. We're looking at employment growth. Is there a big company coming in? Like Tesla just came into west of Katy, which is a brochure area. We're also negotiating 30 acres there to build more mobile home RV park there. We look at all those factors to determine what area where the land that we want to buy. So this is a typical deal structure. We have LPGP structure. Are we gonna get financing from the bank? We usually put down 25%, 75% borrow from the bank. Like I mentioned earlier, briefly, we have those 2 different profit sharing structure with our GP. Okay, and this is my contact info. You can reach out to me at my email or my phone number. Yeah, that's pretty much the overview about my company.
That's great. Appreciate that. We do have some time. So if there are any questions, the group can feel free to drop them in the Q&A. But again, the intent is just to introduce an operator to the community. And if you have interest, you've got the contact information. We'll be sharing that out with the recording of this. And you can reach out to Na directly if you want to ask questions and dig into the company a little bit more. So we'll give I'm not seeing any questions pop up. So unless you have anything else to share, we can jump over to the Kirkland group then too.
Well, Rhonda.
Oh, sorry. Rhonda's got something to present. Forgive me.
Right.
Rhonda, go ahead and jump into your stuff then. Here, you're on mute, Rhonda, too. Just FYI. There we go. There we go.
Yeah. Hello to everyone again. My name is Rhonda Harris, and I am living in the Richmond area. I'm from San Francisco. And about 20 years ago or more, I was faced with a crucial type of a situation that came in our own neighborhood. And so I was given an opportunity to be a person of source to help solve some of those issues. And one of those issues was blight. Properties due to gang violence, drug activity, and antisocial ills. And so looking at those neighborhoods, one I particularly came from in San Francisco, and then looked at a 4-unit property there and was able to turn a commercial, which was a store at the bottom, and turn that into 4 residential units, where today there are families that live in those units. So first experience taking a commercial and converting, going through the process of the planning department and just having to step by step work, turn that into a 3-bedroom. That was in 1999, I believe it was. So there was some time ago. But from there, I branched off and started a business, and that business was what was it? Yeah, RF and Harris, yeah, and Associates. That's what it was. So we from there we started developing and contacting and city officials and finding how ways that we can be more of a source to rid the problems that we were having in our neighborhoods. So what we did was our first opportunity was to, oops, where is it? Okay, was this little home here that was across the street from me. I actually lived in the neighborhood where many of these woes took place. Our family moved in. I was very young in age, about 22, and had family and husband and children. And we watched the neighborhood start to dwindle away. And this particular property was across the street. It was owned by an elderly person who passed away. It was a 1-bedroom. It was in pretty bad shape. It was tagged blighted by the city. And so I purchased it and I got it out of the tax liens, and we renovated it, gutted as we called, and we put that out for a family to purchase, and that took place. We moved on from in that entire neighborhood, purchased another home that was on a corner that was also blighted, totally bombarded by drug activity. And that property was so large that we were able to demo those houses and construct 3 homes. We went back to San Francisco. This is an area where I was brought up and raised, and I was able to purchase this home. It was built in the early 1900s, so it had separate toilets, rooms. The kitchen was cut off. So what we did was we went in and restructured this home, and now it is provided for a organization who provides seniors with housing and services. So that's been rented out to them. Then from there, we at the same time we were doing several renovated properties, because we had partnered up with one of the financial institutions who loved what we were doing and actually were asking us to do more. So this particular property was also a drug infested property on the corner in the city of Richmond, a main artery to get downtown. It was badly abused by drug use. It had needed foundation problems. It was pretty rough, in a bad shape. In fact, so bad that even the realtor wanted us to get this property to do something, that they saw all the other properties we did in the neighborhood, in the area, and wanted us to do this property. It's a 5-bedroom, 2,100 square feet. This property was rented just once to a family. From there, went to an organization who provided clean and sober living for an organization. And then from there, I was led to, in honor of my father, who was a Korean War veteran, wounded, to provide veterans housing. So for 12 years, this house have been a veterans house to provide veterans who are homeless, veterans who were formerly incarcerated, and veterans who are returning from the military. this particular house property here is 2 units. One bedroom, and the other is 5 bedrooms, 3 full baths. We did work on this property, not much, but we did go in and make some changes on this property. We also rented it to an organization who did also provided drugs infested. This property was sitting in an area as well in the Bayview district that was pretty nice and decent, and then drugs came in. And so we also did a facelift on this property. And this property now is, as you see it, we have right now veterans in this house. It is the Veterans Resource Program, San Francisco. So we have Richmond and San Francisco. We provide housing for veterans. We also provide housing in this property for nurses who are traveling nurses at this time. So we have opened up that door for other uses, seeing how it is providing. It is large enough. So we have been on that journey with this particular property. Currently, from our veterans property in Richmond, our expansion goals are to build our veterans housing on a 2.3 acre lot, 268 units. We will provide housing for homeless veterans, independent living veterans with their families, and we will provide housing for assisted living veterans who with their spouse. We also will have 50,000 square feet of commercial for services, and also employment opportunities. We will have culinary arts. We provide also entrepreneurship training. As far as accreditation requirements, I was looking that we did not have any accreditation around, because we typically, our deal structure was typically through financial institutions who actually did seek me out, again, to be assistants, to be that catalyst in the neighborhood. I partnered up with the city of Richmond sometimes to ensure that first-time home buyers were able to receive housing. So the house I'm living in now, we also built this property as well with new construction. So what I do now, I am a consultant with the Department of Veteran Affairs while looking at doing development. That's my heart. I am a general contractor. So that's my heart. Part of my heart is to continue to provide housing services for those who are not as fortunate, those who want to buy a home and cannot. So we look at ways that we can structure deals to get them into their homes. Right now, we're working with the VA. I provide housing for veterans. So in San Francisco, we have 4 locations. And then here in Richmond, we have 1 location. And these are some of the services we do provide for our veterans. And this is who I am. So if you'd like to contact me with, I am a partner with Na, and I am quite grateful and excited to be on another journey, and that would be with RV Parks. So this is who we are, RF and Associates, and I thank you for this time to share. Yeah, thank you.
Thank you. Great. My apologies for you missing out on the joint venture here. So forgive me for not introducing you in as well, Rhonda, but thank you for the presentations. So again, if there are any questions, we've got about 10 minutes still. If there's any questions for either Na or Rhonda, we're happy to field a few of those. But again, feel free to reach out directly to either of them to ask additional questions as well if we don't get anything today. So we'll give it a couple minutes, but thank you ladies both for coming on today and sharing your information.
My pleasure.
Thank you so much for having us.
Yep, we do have one hand up. Dennis, I'm pulling you in. I see your hand up. I'm not sure if you meant to raise your hand or that was an accident, but you should have the ability to ask if you have a question. Looks like maybe it wasn't. If you are asking a question, Dennis, you're muted. All right. Well, no questions coming through. Then we'll share your information, the contact information with the group when we send out the recording. But again, thank you both for coming on and sharing a little bit about your businesses this morning or today.
Thank you.
Thank you.
Thank you.
Then with that, we will turn over the scouting report to the Kirkland Capital Group. And we've got Brock, Ralph, and thought Chris was on too. There he is. Sorry, got all these extra names in today. So guys, we'll turn it over to you, and appreciate you coming on as well to share information about Kirkland Capital Group with us.
Thanks, Jed.
Thank you. Just to want to confirm that you can see the screen I'm sharing.
Yes. Yep.
Okay, great. Thanks. I appreciate you guys hosting us, Chris and I, and then we have our marketing expert online as well, Ralph. And we want to talk today about banks and private lending. I'm sure there's a lot of people out there that want perhaps a little bit more insight into not just what's happening in general with, the bank crisis, et cetera, that's been happening in the last few weeks, but perhaps how that should affect or what effect that's having on debt funds, particularly in the real estate arena. So Chris and I wanted to talk about that a bit. A little bit about us. Won't spend too much time here going through. My background is more on the real estate side, technology, debt, et cetera. Chris comes from a deep background in investment as well. So we both came together to create the Kirkland Capital Group and the Kirkland Income Fund. So the Kirkland Income Fund is a real estate debt fund that's focused on short-term debt for commercial. That might be a little scary, but of course, feel free to ask a question in the Q&A. We can talk about that more. It's not my purpose today necessarily in our presentation to dive too deep into that, but we focus on putting up nice steady returns. But what I want to do here at this point, though, is really pass it to Chris and let him talk a little bit about the banking crisis, particularly because really he's got an interesting background in having lived through 08 in a very different way, working on Wall Street, working for some bigger funds. And maybe we have a little more time for one of his stories that you've got, Chris.
Well, there's always plenty of stories when you go through left tail events. Hi, everyone. I was scouring the internet and found this picture, and I just loved it because it just screams at you of what occurred if you were unaware of what was happening in 2008, 2009, 2010. Obviously, very local to us out here in the Northwest. We had the failure of Washington Mutual Bank, which obviously we led to further problems in derivative products called CDS. And then we had multi-bank issues that led to Lehman's failure. And then if we didn't jump in and save everything, it would have been catastrophic. But even with the TARP funding, even with the saves that the government came in and made, you can see the contagion and the damage that was caused by these large bank failures. So many small names, so many little community banks, regional banks. Now, not all of these are failures, these little dots. They're sometimes mergers of where someone had to be taken out by a bank with a stronger balance sheet. And you can see there was this trickle effect that went on for years, even into 2013 and 14. And I did live through that. I was working for a group that was financing billions of dollars and having to work with a number of different money center banks. And it was scary how early we had a look through the window before even these bank failures were occurring. Most of the heartache started occurring in August of 08, but we were getting people in the beginning of 08, even in December of 2007, calling lines, people calling up and saying, hey, I need my $1 billion back. And that's kind of an odd question when they want $1 billion in about a month. You're not getting it. But moving on from that and kind of now looking at what has occurred just recently is, and I think everyone knows, this chart's a little dated because it came out before Credit Suisse's announcement. So we all know that Credit Suisse, we just kind of plugged it in there because it It is a major failure that, you know, UBS had to come in and help out with, but you've got the failure of Silicon Valley Bank. You've got a lot of things that were happening for Signature. Was kind of a 1-2 punch. You had many failures across a lot of different points in crypto that was hurting, you know, Signature. And then as that run occurred, you also had this, what, you know, you guys all get to say through your investment career, you lived through the fastest rise in interest rates in history. You know, the Fed really moved faster than they ever have, and that caught a lot of people off guard. Usually when you're running these big banks, you know, running your internal debt portfolios, you've got time to react and adjust your portfolio or make negotiations between banks. And it just wasn't possible, you know, for Silicon Valley Bank to move fast enough. And then we quickly saw the same kind of contagion that we saw in 2008 start to affect First Republic Bank. And then now it's affecting even more and more banks. So if you want to, and I really want to pull this, if I can find it, hopefully in about 6 months to a year, when this kind of chart is updated, I want to see what the similarities of, you know, today's events look like what happened in 2008. Do I think we're in an 2008 situation? No, we're not looking at a global financial meltdown, but we are looking at a number of different problems, once again, in banks. And now what people are clamoring about and the sabers are rattling is future regulation of how you're going to be able to withdraw your money from banks, how corporations are going to interact with banks that have large banking, you know, large cash amounts. There's tons and tons of different potential regulations and new ideas on the table to help mitigate this in the future. And I guarantee you, not all of them will be good. But being an ex-hedge fund trader, anytime the government comes in and tries to fix something, yeah, it might hurt something, but have an open mind as an investor, because government regulations usually create some form of opportunity as well. They tend to try to fix one thing and break something else. And so there might be, you know, a new trade for you as an investor out of these changing regulations that we're going to probably have over the next year or so. But
Chris,
yeah,
what's just to give people an idea here, what's the size or estimated size there for Credit Suisse versus Silicon and Signature?
Well, yeah, it's much larger than probably both of them combined, but with UBS coming in and buying them up, I mean, it's really backed by the Swiss government on top of it. So we won't really, Credit Suisse won't be as much of an impact, but it's more of a broader signal that these problems, you know, I always say when money disappears and money's difficult, you know, what happened in 2008 and what's happened, you know, throughout history, when money is no longer cheap and, you know, liquidity dries up, I don't get quote for this, Warren Buffett had this, is, you know, when that occurs, generally the tide goes out and you get to see everybody who, one, was fraudulent, or two, was living on the edge. All of a sudden, now Warren Buffett's actual quote is, when the tide goes out, you get to see everyone who's not wearing any clothes, is the actual quote. But what he's really talking about there are the people who are pretenders. Or in this case, you know, I don't think Silicon Valley Bank was a pretender by any means, but what they were was living on the edge and pushing the limits of risk. And when things moved faster than they could react, they got caught. And that's unfortunate. But yes, Credit Suisse is a much, much larger institution. It is a global money center bank. So the dollar impact is much larger, but we probably won't experience that much in the real estate area due to Credit Suisse's, you know, purchased by UBS.
Yeah.
But now what happens out of this? You know, the impact of lending when this happens. Well, what we're seeing is you got a decrease in lending lines. So a lot of people's warehouse lines are being cut. A lot of people in the real estate lending business, actually across multiple aspects of alternative lending, use credit lines from banks. Well, if you're the supplier of your line is a bank and they're under their own stress, you can guarantee they're going to shore up their lines and you're going to, you know, suffer for that from your business standpoint. So we're seeing a lot of that. We're also seeing a lot of banks, even internally, look at, you know, not only sort of shoring up the private lenders, but shoring up their own book. And, you know, on that second one, they're increasing, their DSCR rates, their debt service, their interest coverage ratios. They're making what used to be able to meet a conventional loan is no longer meeting that goal. So now we've had a lot of loans come to our desk where you've got fully occupied multifamily that is looking for bridge loan because, the banks have pulled a rug pull on some of these borrowers and, purchasers of a property. And they're caught. They're going to need to buy some more time till the banks can figure out what they're going to be doing going forward, or these borrowers, they're going to have to go out and find other banks. The banks that they were working with traditionally, obviously, they're going to have to widen their scope of available, service providers for their business.
Or you're seeing bridge to bridge where
Yep.
someone was expecting to come out of a bridge loan that they got to acquire a property or fix some things, expecting to get that long-term financing, and now getting a no. So seeing a lot of that, talking to a lot of people on the ground, commercial loan brokers who are expressing that planned exit is simply not working anymore for them. And they're having to go to find another bridge loan because the bank or other long-term lenders simply can't take them at this point.
Exactly. Which is further opportunity for us. A lot of these impacts to traditional lending are actually, we don't have a leverage line, nor do we use leverage from a bank. So we're not suffering from anything that's immediately happening from the bank standpoint. But this increase in interest rates, well, if you're on the equity side, which was most of my career, increase the cost of capital was never a good thing, because we all know that's an inverse relationship. But as a lender, and this applies to us and a lot of other private debt now, is this increase in interest rates is allowing you to charge a larger rate. That is what is being, the supply and demand right now is in an imbalance. And anytime that happens and the rates are going up, you're really acting as that person who's stepping in as the bank. You're now the bank. And so you're able to charge much higher rates. And in many, many cases, given the other factors here that we're talking about, do that at a lower risk level. Private debt has always had a very good risk-adjusted return when you're comparing the volatility of returns to the available returns that you can get from private debt. But now you're seeing just an unbelievable spread. I don't know how many people are here are familiar with specific portfolio risk measures like Sharpe and Trainer. But when you run these for your private debt funds, whether it be venture or real estate, they're just off the chart. They're almost ridiculous. They're double-digit, risk-adjusted returns. So this is a perfect time to be thinking of like, well, wait a second, if I've got that cash and I don't need it immediately, and maybe I can tie that up for the next year or so to take advantage of this, it's something to think about. Or if you're waiting for that opportunity to deploy money and you don't have exposure to private debt, it's not a bad time to be considering, because this is something that has just occurred, and we have some legs left in, that trade. So it's, you're not looking at interest rates. The Fed's not going to turn around and lower interest rates. As much as many of my venture capital friends want that to happen, it's just not going to happen. You're just not going to see rates collapse quickly. I know a lot of people say it has to, but I think this last quarter basis point was really a solid sign from the Fed of, we are very homed in on fighting inflation. And we understand that what we've done will cause collateral damage, as it already has. A lot of people are like, well, the Fed can't possibly raise. Look at the damage they're causing to Silicon Valley Bank and all these other regional banks. And they raised 25 basis points anyways, this last March. So don't be surprised if we see a Fed that sticks to their P's and Q's on fighting inflation. And, they're going to let this, they're going to keep hitting the hammer and let that sort of play out until they get what they want. So you're going to be looking at an environment of where we're going to be at higher cost of capital for a longer period of time. And that's going to be great for the private lenders. So, there's always, out of a lot of chaos, there's always opportunities somewhere. And this has been a great place for it.
All right, let me jump in here and talk about, if you want to look at a debt fund, which You're going to join a lot of institutional investors out there. Chris talks with a lot of institutional investors and involved in a lot of that side of things. There's been a tremendous look towards debt. Not that that hasn't already been something that's been on in their portfolio for a long time, but we've seen now the turn of a lot of individual or high net worth investors to discover debt, particularly in this higher interest rate or rising interest rate period. So what are some things that you should look for when we are facing additional risk in the area? What are some things that you should look for or ask as questions to someone that you're looking at or to a sponsor that you're looking at who does debt? So let's walk through a few of these things here. One is property valuation process. I want to lead off with this because this is a huge issue here. One of the reasons that a lot of institutions classically have looked at debt, particularly in volatile times, was because someone else, an equity holder, was holding the cushion on any kind of difference between where you get a haircut on valuation. Now, we're probably hearing, or you've seen the headlines that continue to pop up about the crash or the chaos in commercial property or commercial real estate. Although, truth be told, when you actually look more deeply into those articles and really read what's going on, it's mostly, and I say mostly here, office, and I'll talk about that in a minute. Although multifamily and some other ones are feeling the pinch a bit, but really, when you talk about the value of something going down, it's your equity holders that are going to take the brunt of that hit. Your debt holders are going to be at a better position if, and that's a big if, that the debt fund used as is current values to write that debt and did it fairly conservatively. So when we talk about as is current values, we're talking about, okay, today you bring a property to the debt fund and say, hey, Mr. Debt Fund, I want a loan for this property. And they go, okay, well, no, we're not going to base a loan on some future value that you may get to, that you may bet on. Sometimes we call that ARV or after repair value, or even sometimes loan to cost on a construction loan. Those are all things we're looking at basically almost like future value. That we hope that it gets to that value. What you want is conservative approach, which is based on current value today when you've got high vacancy, today when you've got issues with the property. What is the value today? And we're going to base that loan today on what that is. Second, in a debt fund, you want to ask, what's your exposure to different asset classes? And really key on really the biggest one that's been in the news a lot is office. Now, even in Seattle, where we are at, where they were constantly talking about office being, how do I want to say, oh yeah, office is going to come back, is going to come back. We didn't think that it would come back years ago when the pandemic started. We just thought that, well, there's a lot of stuff queued up there that's going to bring trouble to the office asset class that enables people to work remotely if they are able to, job-wise. That's going to just bring future problems. And COVID really accelerated that. And now people don't want to come back. We can see that with key card stripes. Really, if you want to fight what the data is, that's really hard to do. You can try and convince people, oh no, they're going to come back, look at this leasing or that leasing, or things are still leased up. Yeah, that's because people are on the line in office for 5, 10, 6, 7 year leases. But the key card swipes are still around in the 40s, the 40%, I think last I heard it was like 43% for a lot of primary markets for office. So that there's going to be continued decimation there. So you want to look to debt funds that are writing debt in maybe more stable asset classes or in markets where things are more stable. That's where sometimes if you look at primary markets where you had really low cap rates, think about it, that cap rate is really a gear on what the valuation of that asset is. So if you have a super low cap rate, let's say going from a cap rate of 2 or 3 or 4, and then going up 1 is going to mean a pretty big difference to that the value of that property. Whereas let's say you take a secondary or tertiary market where the cap rate may have been, I don't know, 10, 11, and you go up, 1 on the cap rate, you're not talking about a large move in that valuation, at least not as large as when you talk about primary markets and those low cap rates. So that's a troubling aspect of some primary market type assets. Constant and consistent revisit of underwriting. You got to ask the question about, well, how often do you revisit your underwriting guidelines? How often do you look at those? How often do you adjust those? Are you trying to look ahead? Are you being reactionary after you've had something good crash and burn or a foreclosure? Have you adjusted LTVs, loan to values on certain asset classes, or depending on what the risk factors are for the borrowers you're looking at? Have you looked at pricing? Am I, as an investor in a debt fund, and this is a key question here, am I going to benefit if you're going out on the risk curve or taking a bit riskier loan? Are you pricing that higher? And then are you passing that higher pricing to the investor, to me as the investor? That's what you want to ask a sponsor. So that if you're going and, let's say, making a loan on a little riskier property, or with a borrower has had a little bit of trouble in the past, maybe it's a higher vacancy on a property and it needs to be leased up. Well, that's a little more risky in this market. Okay, but maybe that's fine. Maybe you feel good about that property as an underwriter, but let's say that debt fund raises the pricing on saying, well, we got a vacancy, we're going to charge 50 basis points more. Are they passing that on to you as an investor, or are they keeping that? That's a key question to be asking for debt fund sponsors, or to debt fund sponsors. The other one, underlying properties are income generating now or very soon. Look, I am not saying at all that there's not a lot of money to be made in the debt space for ground up construction. There's a ton of money to be made. However, in this market that we're in, just be aware that that is an additional risk on top of some debt funds who are just doing only income generating, or only owner occupied, which can be income generating. They're not looking out 12, 18 months on a construction project and hoping that that value is going to be there and they're going to be able to lease up or lease out or whatever it is that needs to be done to get that money and pay it back to the debt fund. Raw land is another one that for a debt fund, honestly, it's not an income generating thing. So it's a little bit more dangerous because you might be able to sell it, but that's your only real exit there. It's really a more difficult thing as a debt fund. There might be more stuff on the equity side, honestly, for raw land, just because when you've got challenges in the marketplace, what we have now, as an equity investor, going and picking up raw land because it's not generating that income, and you've got people on the equity side who are hard pressed to maybe generate some cash, and they're selling off, well, I can let go of this raw land because it's not generating income. There's probably some deals to be had there on the equity side. But from a debt fund side, I'd say be very careful for debt funds who are writing debt on those items there. Senior debt positions. Ask, what are you making seconds? Are you making thirds? Are you doing lines of credit? Where does your debt sit? Is it first lien? Are you first in line if something goes wrong to get our investor money back on a debt fund? So are you writing a first lien debt position? And on top of it, are you full recourse? If something goes wrong and you are not able to get all the money back from a sale of that property, are you able to go after after a borrower personally, all their assets, their other assets that they hold? Are you able to go after them and get and do and get that money back? So a deficiency judgment is what it's called. So if you go and you do foreclose on someone, you get a deficiency judgment from the judge on that piece of property, and now you're able to go after that person, those guarantors, personally for anything that you weren't able to cover in selling that property off and still owed to the lender. So that's a good question to ask. Are you getting those personal guarantees? What are they requiring from borrowers? Now, classically, if you talk about the old hard money lender, he's the guy or gal who went out, boots on the ground, drove by a property. Yeah, that looks good. I don't need to know anything about the borrower. I'm an asset-based lender. Well, okay. that's great. You got an asset that's worthwhile, but that's going to be higher risk. So again, some of this is not saying don't do this. Some of this is really talking to you about risk mitigation, or if you choose to go and invest in a lender who's doing this, are you as an investor being rewarded for that extra risk? If not, then you should be looking at these items where, look, we don't do liar's loans, or are you doing liar's loans? You know, you remember that from 08, a lot of those loans that went bad on the residential side, you know, the old liar's loan, stated income, you know, which was probably no income at all. You barely got a job. We used to joke that, and I was in the business working for non-bank lenders at the time, that look, you know, if a cockroach probably applied for the loan, they could get 100% financing. I mean, you know, there was jokes going around about someone heard that a dog got financed. You don't want that. You don't want an asset-based only loan. You want to ask these questions to the debt fund or to the sponsor of the debt fund. Are you requiring full docs? Are you doing criminal background checks on the borrower? Are you getting full tax returns? Because Lord knows we don't want Uncle Sam coming after these properties because they didn't pay their taxes. Are they doing, you know, people lie on taxes all the time. How do you even know that you're getting the correct tax returns? So are you going and doing an 4508, sorry,
4506.
Thank you, 4506. And are you going and getting from the IRS tax transcripts on all of it? Are you checking with the IRS on what their current today's balance? Do they owe anything? Do they pay their taxes? And I can tell you one thing right now, and we're seeing a lot of this as a debt fund when we go check, is that people don't pay their taxes when things are pressed. They'll let Uncle Sam go. They're going to pay other things. And so we're seeing a rise in the amount of people that they file their taxes, but they didn't pay their taxes. So this could be a big problem, particularly with real estate investors who a lot of times they're not like a W-2 person who gets taxes taken out every month. And usually Uncle Sam owes them at the end of the year. For a lot of self-employed, for a lot of real estate investors, when April 15 comes around, they owe thousands and tens of thousands of dollars of taxes, which they may have not paid. You know, are you getting bank statements? Are you really getting that full picture of the borrower in order to reduce risk, even if the property may look good? So these are, this is not an exhaustive list by any means, but we wanted to give you some things to look for if you're considering to invest in a debt fund, looking for lowering your risk or looking for that lower volatility, that steady income coming in. What are these things to look for? So I hope this has been helpful for you.
Good stuff, guys. Appreciate the detail and the info share. Here's your information to connect to. We'll put it open for questions for a little bit. We've got a little bit of time if there's any questions that pop up. But again, really appreciate you guys coming on, sharing information. Just, I guess, a reintroduction of you guys to the community, really more than anything. But
it's been a while since we've talked.
Right,
to your group, so we're happy to be back.
Yeah, we appreciate that too. So, but you got the contact information. We will package this up again with the recording, get that out early next week. Feel free to reach out and ask questions directly to each group. And we'll see if we don't have them come back for another webinar at another point in time. But thank you to everybody for participating today and getting to share your information with our community. We appreciate that.
Thank you.
All right. Thank you.
All right. Thanks, everybody.